alaikum, my dear students. In this video, we are going to discuss the capital structure decision in multinational companies. Once you hear word capital, you should remember three words: long-term funds. On the other hand, structure is simply components of something, in our case, that is capital. So you want to talk about different components of long-term funds used to finance long-term assets in some company. As discussed in the last lecture, we focus on multinational corporation whose parent fully owns foreign subsidiaries in foreign countries. So we can use sample case in which MNC, whose parent company placed in United States, and it fully owns three major subsidiaries in foreign countries, where the first located in United Kingdom, the second is located in France, and the third placed in Japan. Multinational corporations rely on capital to finance the creation of new subsidiaries or their expansion of existing subsidiaries and other projects. The main topics we are going to discuss about capital structure in MNCs include the main components of capital structure, in addition to analysis of MNC's capital structure decisions and how it can be affected by subsidiary financing decisions. First of all, we want to refresh your memory and think about how to get information about capital structure of a company. In other words, how the assets of a company funded. We search about sources of capital. Let me show a simplified form of a balance sheet of a company in which we observe in the above part the assets with book value of $22 million, while in the part below the liabilities and owner's equity. According to the balance sheet equation, the assets of company are financed from liabilities and equity. Thus, liabilities and the owner's equity are sources of funds, short-term and long-term sources of funds. And because we want to identify the sources of long-term funds, we consider long-term liabilities as the first components of the capital, representing debt financing of about 5.5 million, while the owners of the company contribute with $13 million, representing equity financing. Thus, the capital amounts to $18.5 million. The structure indicates percentage of equity in capital and the percentage of debt in capital. We can get the percentage of debt in capital structure by dividing amount of debt over amount of capital. So 5.5 million over 18.5 is equal to 0.3 or 30%, which means that 30% of capital structure or 30% of the capital is financed from debt. 30% of capital is from debt. By the same way, if we divide amount of equity over the amount of capital, so 13 million over 18.5 is equal to 70%, which means 70% of the capital is from equity. In other words, assets of the company is financed 70% of the assets of the company is financed by equity. Notably, summations of both weights has to be equal to 100%. So weight of equity is 70% while weight of debt is 30%. Can we derive ratio representing relation between debt and equity? Sure. Debt equity ratio reflects how much dollars of debt in capital for each dollar of equity. This means that for each $1 from equity, there is 0.42 dollars from debt because weight of equity is greater than weight of debt. We can get the debt equity ratio using the equity ratio and the debt ratio. By dividing 30% over 70%, we will get the same debt equity ratio using the amount of debts and the amount of equities. In the last slide, we talk about existing capital structure of a company. What about possible sources of capital? Broadly speaking, we can classify sources of capital as internal and external sources. Internal sources indicate to amount of funds that can be generated from operations of a company, that is its retained earnings. So in the last example, we observe that retained earnings is $3.7 million under the section of owner's equity because they are rights of the owners. Retained earnings are accumulated earnings after distributing cash dividends to stockholders, and they are set aside to finance any potential expansions for the business. If the retained earnings are not sufficient, the company resorts to external sources of funds. There are two main sources of external sources of capital: equity financing, including common and preferred stocks, and debt financing, including loans, bank loans, and bonds. So in this slide, we attempt to discuss the ways by which the MNC use retained earnings by generated by the parent company and their subsidiaries. So MNC's parent and its subsidiaries commonly generate earnings which can be retained and reinvested to support existing operations or to be used for expansions. The first objective of retained earnings, that is, support existing operations, can be achieved by two ways. Firstly, the MNC may ask each subsidiary to retain sufficient earnings to cover its expected operating expenses denominated in the same currency. This strategy could minimize amount of cash flows between the parent and the subsidiary that must be converted into a different currency. But the subsidiary may need more funding than recent earnings, and in turn, the multinational corporation should support it with needed funds. Another way the retained earnings can be used by the multinational corporation if the multinational corporations may ask its subsidiaries to remit the earnings to cover the parent's operating expenses in the near futures. So they will convert from foreign currencies into the home currencies using the current forex rate. The second objective of retained earnings is to finance expansions. So multinational corporations can use retained earnings to expand internationally by establishing new subsidiaries. As we said before, the multinational corporation can use debt as external sources of funds to finance expansion. Typically, the multinational corporation has several sources to get debt. It can issue bonds privately. It can issue bonds either domestically or globally, and it can issue bonds privately either domestically or globally. Alternatively, it can take loans from financial institutions either in home or in foreign countries. Let us discuss each one in more detail in the next slides. Domestic bond public offering. When the multinational corporation decide to offer bonds in home country priced in the home currency with assistance of investment bank, which help company in determining the amount of offering, the offer price, and allocation methods. Corporate bonds usually have maturities range from 10 to 20 years. But if the multinational corporation plans to provide portion of proceeds to its subsidiary in Japan, for example, it will need to convert from dollars, which is a home currency, to Japanese yen at the prevailing forex rate. If the parent company needs $20 million to finance its home operations, and its British subsidiary needs 15 million British pounds to finance its operations, and its Japanese subsidiary needs 10 million Japanese yen to finance its operations in Japan. So the multinational corporation placed in United States will engage in a global bond offering in which the multinational corporations will sell $20 million bond to US investors in United States, and the multinational corporations will sell 15 million British pounds bonds to its investors in UK, and the multinational corporations will sell bonds at 10 million Japanese yen to finance its subsidiary in Japan. So the parent will rely on revenues from its own operations to pay coupon payments on dollars-denominated bonds, and the British subsidiary will use pounds-denominated revenues to pay coupons on bonds-denominated bonds, to pay coupons on pound-denominated bonds. And the Japanese subsidiary use yen denominated revenues to pay coupons on yen denominated bonds. The multinational corporations can offer bonds privately to a few number of financial institutions in the home country or in foreign country where the multinational corporation is expanding. The main advantage of private placement is that involves lower transaction costs because the bond is placed to a small number of large investors. The main disadvantage of private placement relative to investors is that privately placed bonds may carry some restrictions on their resale in the secondary market. Thus, they may offer limited liability to investors. Moreover, the multinational corporations may not be able to obtain all the funds that they need with a private placement of debt. Both multinational corporation and its subsidiaries can borrow funds from local financial institutions. Other advantages include access multinational corporation to other services such as forex and cash management provided by banks. If the multinational corporation wants to borrow a large amount of funds, it may rely on syndicate of lenders rather than a single lender. The structure of a syndicated loan can be customized to meet the multinational corporation needs. For example, the loan can be segmented into portions so that each portion is denominated in a currency that is needed by a particular foreign subsidiary. External sources of equity includes equity offering, which can be taken in domestic or can be placed globally, and the private placement of equity, which also can be implemented in a home country, and it's called domestic private placement, or in foreign countries and will be called global private placement of equity, or the subsidiaries offering of its own stock after the approval of the parent company. The multinational corporations can issue shares in home country in two ways. If they issue shares to public investors in home country and in home currency, it will involve large transaction costs, but it provides more liquidity to investors. And the multinational corporations will be exposure to forex or foreign exchange risk if it decides to convert a portion of the proceeds to their subsidiaries. The second way of domestic equity offering is private placement, in which the multinational corporation issues shares to financial institutions denominated in the local currency. It involves lower transaction costs, but investors face less liquidity, or the investors face a liquidity risk because the equity may be subject to conditions regarding to its resale. The second disadvantage of private placement is that multinational corporations may not be able to obtain all the funds that they need with private placement or using private placement. If the United States multinational companies' large subsidiaries are in need of financing, the multinational corporations will engage in global equity offering. Thereby, they can simultaneously access equity from multiple countries. The stock will be listed on an exchange in the foreign country and denominated in the local currency, so that investors there can sell their holdings of the stock in the local stock market. For example, if the Japanese subsidiary needs a fund, so the United States multinational company can sell a portion of the global stock in Japan, dominated in Japanese yen, and the proceeds of the equity offering will be used to support the operations of Japanese subsidiary. In this process, the issue of equity in Japan should be listed on Japanese stock exchange to enable Japanese investors to buy or sell their holdings of the stock in the local stock market, which is Japanese stock exchange. And by the same way, if the British subsidiary needs funds to support its operations, the multinational corporations can sell a portion of the stock in UK, dominated in the British pounds, and list this shares on London Stock Exchange or the British stock market to enable British investors to buy and sell their holdings of the stock in their local stock market. Suppose we have the multinational company has a subsidiary in Japan which needs funds. The foreign subsidiary, that is Japanese subsidiary of the multinational company, could engage in a public offering of its own stock. The main disadvantage is that this subsidiary would no longer be wholly owned by the parent, although the parent would likely remain as the major owner. The second disadvantage is the agency problem between the managers of subsidiaries and the managers' stockholders. For example, they may use funds for projects that are feasible from their perspective, but not from the parent's perspective. Although some subsidiaries have issued their own stock, most multinational company parents prefer to own all the equity of their subsidiaries. Thus, the subsidiary is more likely to increase its equity over time by retaining earnings than by issuing its own stock. The multinational company's capital structure decisions is very critical decisions. Why? Because it includes the debt financing decisions, which is critical one than equity decision. Why? Because debt financing requires periodic interest payments, and in case of defaulting, the company has risk of bankruptcy. On the other hand, it has major advantage that it has a lower cost than equity, because debt financing involves tax savings, because the interest is deducted from the taxable income before paying taxes. So paying interest will lower the taxable income or the income which will subject to taxations. This advantage results in lower cost of capital or lower cost of debt than the cost of equity. So the main disadvantage of debt financing is the probability of bankruptcy. So decisions of issuing debt or equity is subject to or affected by two main types of characteristics: the corporate characteristics and host country characteristics. The corporate characteristics include the cash flow stability of the multinational companies and its credit risk, and multinational companies' access to retained earnings, and the agency costs of the stockholders in the multinational companies. The first company characteristics is that the multinational corporation's cash flow stability or cash flow stability of multinational company. A multinational company with more stable cash flow means that it can cover the periodic interest payments in time. So this company can use more debt. Otherwise, if the multinational corporation has unstable cash flow, it may be unable to cover periodic payments, so it will use less debt. If the multinational corporation is diversified across several countries, which means it has many subsidiaries in foreign countries, conditions in a single country shouldn't have a major impact on cash flow of the multinational corporations, and they may have more stable cash flow and they can handle more debt. The second corporate characteristics is that multinational corporations' credit risk. Multinational corporation with assets that serve as collateral can secure loans, so it will prefer debt financing. But in addition, the multinational corporations if the multinational corporations guarantees the subsidiaries debt, so it will increase the subsidiaries borrowing capacity, but on the other hand, it will decrease the parent's borrowing capacity because creditors are unwilling to lend funds to parent if those funds might be needed to rescue the subsidiary. The third characteristic is access to retained earnings. Highly profitable multinational companies may able to finance investment with retained earnings and so use less debt. Conversely, multinational company with small levels of earnings need more funds to finance their operations, so it will use more debt. Growth-oriented multinational company needs more funds than can be accessed from retained earnings, so it will use more debt. Conversely, the less growth multinational companies are able to rely on retained earnings instead of debt, so they will use less debt. The fourth characteristic is that agency cost. Suppose that multinational companies' shareholders cannot easily monitor the managers of a subsidiary, so the agency costs will be higher. So the parent company may require the subsidiary to rely more on debt financing because this will force the subsidiary to be disciplined to cover its periodic loan payment. We can summarize the characteristics related to the company in this slide. The debt-intensive capital structure can be chosen by the parent company if it has a stable cash flow and it has low credit risk and experiences smaller levels of retained earnings, and the higher agency of the multinational companies shareholders is high. The host country characteristics. Actually, we have four characteristics related to the host country in which the multinational company has subsidiaries. The first characteristic is interest rate in the host countries and strength of the host country currency, the country risk, and the tax law in host country. We will discuss each characteristic in more detail in the next slides. The first characteristics of the host country is the interest rate in host country. If the interest rate in a subsidiary country appears excessive or very high, the parent company may prefer its own financing, which is equity, for funding projects implemented by the subsidiary. The second characteristic of the host country is the strength of its currency or strength of host country currency. If the multinational corporation expects depreciation in currency that subsidiary's host country, depreciation in currency of the subsidiary's host country, the multinational company will instruct its subsidiary to finance a large percentage of operations using debt denominated in this currency. As a result, the subsidiary remits smaller amount in earnings because it makes interest payments on the debt, which will reduce the multinational company's exposure to foreign exchange risk. Foreign subsidiaries of the multinational corporations may be subject to withholding tax when they remit earnings. By using local debt financing instead of relying on parent financing, they will make interest payments on the local debt that should reduce the amount to be remitted periodically. Thus, the subsidiary reduces the withholding taxes by using more local debt financing. The fourth characteristic of the host country is the country risk. The first type of country risk is that the possibility that the host government will temporarily block funds to be remitted to the parent. So the multinational corporation will instruct its subsidiary to use local debt financing to pay interest and thereby reduce amount of funds that are blocked. The second type of country risk is that possibility that the host government might confiscate its assets. Then the subsidiary may rely mostly on domestic debt financing. So local creditors may have to negotiate with the host government to obtain all or part of the funds they have loaned after the host government liquidates the assets it confiscate, confiscates from the multinational corporation. Alternatively, the subsidiary can issue stock in the host country, so the major stockholders could pressure their local government to refrain from imposing excessive taxes, environmental constraints, or any other provision could reduce the subsidiary's profits. So we can summarize the host country characteristics as follows. Lower interest rate in host countries and the expected depreciation in currency of the subsidiary's host country, high host country risk, increasing withholding tax law in the host country will push the multinational corporation to use debt-intensive capital structure. Let me show an example. If the multinational company is concerned that Japanese yen will depreciate substantially over the next 2 years, what will be the decisions of the multinational company? The company will instruct its subsidiary in Japan to remit all earnings to the parent over the next 2 years before the yen depreciates. Consequently, the Japanese subsidiary cannot rely on retained earnings to support its operations and must rely more heavily on local debt. If the multinational company has a subsidiary in UK where the government has announced that it will eliminate its withholding tax on remitted funds, the decisions will be the subsidiary will now remit more of its earnings to the parent. Thus, the subsidiary will rely less on retained earnings and more on local debt to support its operations. The third scenario, what if the multinational company has subsidiary in France where the government has announced that it will block the remission of funds for the next year? The decisions will be the subsidiary will use the blocked funds that it will otherwise have remitted to pay off its local debt in France. This subsidiary's capital structure will become more equity intensive. What if the multinational company has a subsidiary in Argentina that will rely more on retained earnings because local interest rates have increased, thereby increasing the cost of local debt? The subsidiary's capital structure will become more equity intensive. In the last 4 scenarios, we know that country conditions caused 2 of the subsidiaries to use more debt-intensive capital structure and 2 other subsidiaries to use more equity-intensive capital structure. Thus, these characteristics explain not only why the optimal capital structure may vary among countries, but also how the optimal capital structure could change within any particular country over time. When the multinational company has a foreign subsidiaries, its overall or global capital structure is a combination of the capital structures of the parent and all subsidiaries. The capital structure of multinational company subsidiaries may vary because some subsidiaries are subject to conditions that favor debt financing, whereas others are subject to conditions that favor equity financing. Because the subsidiary's capital structure decision affects the amount of retained earnings that are remitted to the parent, that decision affects That decision affects the amount of equity contributed to the parent and so affects the parent's capital structure. Suppose that the multinational company has a global target capital structure of 0.9, thereby the debt equity ratio will be at 0.9, which means that each $1 from equity has $0.9 from debt in capital structure. To maintain this ratio, the capital structure decisions of subsidiaries should be made in consultations with the parent. The potential impact of subsidiary financing on the parent's capital structure is illustrated in the next slides. So, what is the effect of subsidiaries' increased debt? When a subsidiary uses more debt, it needs less internal funds or retained earnings. So, the subsidiary will remit the extra internal funds to the parent company. The parent will itself have a larger amount of internal funds and will use less debt to finance or to support its operations. To offset the impact of increased debt by the subsidiary. In other words, because the subsidiary may have more financial leverage than is desired for the multinational company, the parent may use less financial leverage to finance its own operations in order to achieve its overall or global target capital structure. What about the impact of subsidiaries' decreased debt? When a subsidiary uses less debt in its capital structure, it will need more internal funds to support its operations. So it will remit fewer funds to its parent company. And the parent will itself have a lower amount of internal funds. So the parent company will use more debt in capital structure to offset the impact of decreased debt by subsidiary. In other words, because the subsidiary may have less financial leverage than is desired for the multinational company, the parent may use more financial leverage to finance its own operations in order to achieve its global target capital structure. So the multinational company can still achieve its target capital structure by offsetting a subsidiary's change in financial leverage with an opposite change in the financial leverage of another subsidiary or of the financial leverage of the parent company. So the parent company follow offsetting strategy to achieve the global target capital structure. Our lecture case today will discuss multinational capital structure decisions at the sports exports company. Let me introduce the company. Its name, the Sports Exports Company. It has considered a variety of projects, but all of its business is still in United Kingdom. Because most of its business comes from exporting footballs denominated in pounds, it remains exposed to exchange rate risk. On the favorable side, the British demand for its footballs has risen consistently every month. Its capital structure. Jim Logan, the owner of the Sports Exports Company, has retained more than $100,000, of course after the pounds were converted into dollars, in earnings since he began his business. At this point in time, his capital structure is mostly his own equity, with very little debt. So this capital structure is called equity intensive capital structure. The international plan of this company for expansions, Logan, the owner of the company, has periodically considered establishing a very small subsidiary in the United Kingdom to produce the footballs there so that he wouldn't have to export them from the United States. Options for capital structure. If he does establish this subsidiary in UK. The first option is to use all of his equity to invest in the firm. The second option is to use pound-denominated long-term debt, or the third option is to use dollar-denominated long-term debt. If you know the market conditions about interest rates, the interest rate on British long-term debt is slightly higher than the interest rate on US long-term debt. The required is what is an advantage of using equity to support this subsidiary, and what is disadvantage? The second question is about if Logan decides to use long-term debt as a primary form of capital to support this subsidiary. Should he use dollar-denominated debt or pound-denominated debt? The third question is about how can the equity proportion of this firm's capital structure increase over time after it is established. The first question is that what is an advantage of using equity to support the subsidiary, and also what is a disadvantage of using equity to support this subsidiary. The main advantage is that the returned earnings may be a relatively low-cost method of financing. The use of equity to support the subsidiary is especially effective if Jim did not have any other plan for using the equity. On the other hand, the disadvantage of using equity is that it has to be converted into pounds to support the British subsidiary. This creates a new form of exposure to the future value of the pound, which is similar to the exposure that the firm would have reduced by producing the footballs in UK. When earnings are remitted to the US, they are converted into dollars and are exposed to exchange rate movements. The firm could have reduced this exposure by using pound-denominated debt and owing interest payments denominated in pounds. In this case, there would be a smaller amount of pounds remitted to the US because the cost of using debt capital would be pulled out before any pounds are sent to the United States. The second question is about if Jim decided to use long-term debt as its primary form of capital to support this subsidiary. Should he use dollar-denominated debt or pound-denominated debt? The answer is that Jim should use pound-denominated debt because this creates a cash outflow on interest payments that offsets part of the cash inflow and therefore reduces the exchange rate risk. Even though the dollar-denominated debt has a slightly lower interest rate, the actual cost of financing with a dollar-denominated debt could be much higher if the pound weakens over time because it would take more pounds to convert to dollars to make the interest payments. The third question is about how can the equity proportion of this firm's capital structure increase over time after it's more established? The answer is simply it will generate earnings that can be retained and reinvested as an equity investment in the firm.